Today we're diving into the world of financial ratios, a powerful tool for understanding companies' financial health. Whether you're an investor, business owner, or just curious about finance, mastering these ratios can help you make smarter decisions. We'll break down what financial ratios are, why they matter, and how they're used in real-world scenarios. By the end of this video, you'll have a solid foundation to analyze any company's performance with confidence. Let's get started by exploring the basics and setting the stage for deeper insights. Financial ratios are simple calculations that compare different numbers from a company's financial statements. They help us quickly assess aspects like profitability, liquidity, and efficiency. Think of them as shortcuts to understanding complex financial information. Instead of getting lost in pages of numbers, ratios give you a snapshot of how well a business is doing. In the next scenes, we'll look at the main types of ratios and see how each one reveals a different part of the financial picture. Why do financial ratios matter so much? Well, they allow investors, managers, and analysts to compare companies of different sizes, spot trends over time, and identify strengths or weaknesses. Ratios are like the vital signs of a business. They reveal what's working and what needs attention. Whether you're looking to invest, manage, or simply understand a company, ratios are essential tools for making informed decisions. There are several categories of financial ratios, each serving a unique purpose. The main types include profitability ratios, liquidity ratios, leverage ratios, efficiency ratios, and market value ratios. Each category helps answer different questions about a company's performance and financial stability. In the following scenes, we'll break down each type and see how they're calculated and interpreted. Profitability ratios measure how well a company generates profit from its resources. These ratios show whether a business is making money and how efficiently it's doing so. Common examples include the net profit margin, return on assets, and return on equity. By analyzing these, you can see if a company is turning sales into actual profit and how it compares to competitors. Net profit margin tells you what percentage of revenue remains as profit after all expenses are paid. It's calculated by dividing net income by total revenue. A higher margin means the company keeps more of its sales as profit, which is usually a good sign. This ratio is especially useful for comparing companies in the same industry. Return on assets, or ROA, measures how efficiently a company uses its assets to generate profit. It's calculated by dividing net income by total assets. A higher ROA means the company is making good use of its resources. This ratio helps investors see if management is effectively turning investments into earnings. Return on equity, or ROE, shows how well a company uses shareholders' equity to generate profit. It's calculated by dividing net income by shareholders' equity. A high ROE means the company is rewarding its investors well. This ratio is especially important for shareholders who want to see strong returns on their investment. Liquidity ratios focus on a company's ability to meet short-term obligations. They show whether a business has enough assets to cover its debts as they come due. The most common liquidity ratios are the current ratio and the quick ratio. These are crucial for lenders and suppliers who want to know if a company can pay its bills on time. Current ratio compares a company's current assets to its current liabilities. It's calculated by dividing current assets by current liabilities. A ratio above 1 means the company has more assets than debts due soon, which is generally positive. However, a very high ratio might suggest unused resources. It's all about balance. Quick ratio, also known as the acid test ratio, is a stricter measure of liquidity. It excludes inventory from current assets, focusing only on the most liquid assets. This ratio tells you if a company can meet its short-term debts without selling inventory. It's especially useful in industries where inventory isn't easily turned into cash. Leverage ratios examine how much a company relies on debt to finance its operations. These ratios help assess financial risk and long-term stability. Common leverage ratios include the debt-to-equity ratio and the interest coverage ratio. Investors and creditors use these to judge whether a company is overextended or managing its debt wisely. Debt-to-equity ratio compares a company's total liabilities to its shareholders' equity. It's a key indicator of financial leverage. A high ratio means the company is using more debt, which can increase risk but also boost returns if managed well. This ratio helps you understand the balance between borrowed money and owner investment. The interest coverage ratio shows how easily a company can pay interest on its debt. It's calculated by dividing earnings before interest and taxes, EBIT, by interest expenses. A higher ratio means the company is more comfortable meeting its debt payments. This is important for lenders who want to ensure they'll be repaid. Efficiency ratios measure how well a company uses its assets and manages its operations. These ratios include inventory turnover and asset turnover. They reveal how quickly a company turns resources into sales or cash. High efficiency means the company is making the most of what it has, which is always a good sign. Inventory turnover shows how many times a company sells and replaces its inventory during a period. It's calculated by dividing cost of goods sold by average inventory. A high turnover means inventory is selling quickly, which is usually good. However, too high could mean stockouts, while too low may signal overstocking. Asset turnover measures how efficiently a company uses its assets to generate sales. It's calculated by dividing net sales by average total assets. A higher ratio means the company is using its assets well to drive revenue. This ratio is especially useful for comparing companies in asset-heavy industries. Market value ratios help investors evaluate a company's stock price relative to its financial performance. These include the price-to-earnings (PE) ratio and the market-to-book ratio. They're especially important for those considering buying or selling shares, as they indicate whether a stock is overvalued or undervalued. The price-to-earnings, or PE, ratio compares a company's stock price to its earnings per share. It's a popular tool for valuing stocks. A high PE might mean investors expect growth, while a low PE could signal undervaluation or trouble. Always compare PE ratios within the same industry for best results. The market-to-book ratio compares a company's market value to its book value. It's calculated by dividing market price per share by book value per share. A ratio above 1 suggests the market values the company more than its accounting value, often due to growth potential or intangible assets. Using financial ratios isn't just about calculating numbers, it's about interpreting what they mean. Always compare ratios to industry averages, past performance, and competitors. Look for trends over time, not just single data points. This approach gives you a clearer picture of a company's strengths and weaknesses. While financial ratios are powerful, they're not perfect. Ratios can be affected by accounting methods, one-time events, or industry differences. They're best used as part of a bigger analysis, not in isolation. Always dig deeper if something looks unusual and combine ratios with other information for the best results. One of the biggest advantages of financial ratios is the ability to compare companies, regardless of size. By using ratios, you can see which company is more efficient, profitable, or financially stable. This makes ratios essential for investors, analysts, and managers looking to benchmark performance. Tracking financial ratios over several years helps you spot trends and patterns. Is profitability improving? Is debt increasing? By looking at ratios over time, you can see if a company is getting stronger or facing challenges. This long-term view is crucial for making smart decisions. Different industries have different standards for financial ratios. What's considered a good ratio in one industry might be poor in another. Always compare ratios to industry benchmarks and understand the context. This helps avoid misinterpretation and leads to better analysis. A common mistake is relying too much on a single ratio or ignoring the context. Always use a combination of ratios and look at the bigger picture. Watch out for unusual spikes or drops and investigate further if something seems off. Good analysis is about asking the right questions. Let's look at a real-world example. Imagine two companies in the same industry. Company A has a higher profit margin but lower asset turnover, while Company B has the opposite. By analyzing their ratios together, you can see which company is more efficient or profitable overall. This approach helps you make informed choices. Investors use financial ratios to decide where to put their money. By comparing ratios like PE, ROE, and debt to equity, they can spot undervalued stocks or avoid risky investments. Ratios are a key part of any smart investment strategy, helping you balance risk and reward. Managers use financial ratios to monitor performance and set goals. By tracking profitability, efficiency, and liquidity, they can identify areas for improvement and make better business decisions. Ratios are practical tools for running a successful company and staying competitive. To wrap up, financial ratios are essential tools for understanding a company's financial health. They help you compare, analyze, and make informed decisions. Remember to use multiple ratios, consider industry context, and look for trends over time. With these skills, you're ready to dive deeper into financial analysis and make smarter choices in business and investing.